Happy Monday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. Let's jump in. And we begin in North America. Over the weekend, UK-based The Financial Times published an interesting piece arguing that Wall Street's American exceptionalism trade has been shattered in recent weeks. Quote, as the fallout from Donald Trump's tariffs and uncertainty over the economic outlook and geopolitics have fueled an unusually prolonged and deep twin sell-off of the US dollar and equities. End quote. Let's examine some of this argument. The US dollar has slumped by 4% against a basket of major currencies this year, while the S&P 500 index has fallen by nearly the same percentage. These sharp declines mark an unusual departure from the trend of the US financial assets outperforming their global counterparts, a shift noted by analysts at Goldman Sachs. The firm described the rapid equity correction, the dual correction, as one of the fastest since the 1970s, as a sign of eroding investor confidence in US economic supremacy. At the heart of the turbulence is US President Trump's aggressive trade policy, which has rattled markets. New tariffs on key trading partners, including Mexico, Canada, and China, have prompted concerns over economic growth. The Federal Reserve, acknowledging these risks, recently downgraded its US growth forecast while raising its inflation outlook. Now, proponents of the tariffs defend the president's moves, arguing that this is simply short-term pain from uncertainty and that in the longer run, the policy shifts will be beneficial for the US and its economy. On this point, of course, only time will tell. Until recently, Wall Street stocks had been the undisputed global leaders. From 2023 to 2024, MSCT's US equities index surged by 54%, vastly outperforming the 17% rise in developed markets excluding the US. However, the momentum has reversed, with global indices now outpacing American assets. JP Morgan strategists have turned bearish on the dollar for the first time in 4 years, citing, quote, uncertain tariff delivery, end quote, and signs of a slowing US economy. Investors are increasingly diversifying away from US markets, with funds flowing into international equities. Scott Chun, Chief Investment Officer of the California State Teachers Retirement System, noted that Trump's executive orders have injected, quote, tremendous uncertainty, end quote, into the financial landscape. Despite the sell-off, some analysts argue that it is too early to declare the end of American exceptionalism. Safe haven demand for US treasuries remains strong, albeit focused on short-term bonds. As Eric Winograd of AllianceBernstein put it, markets are, quote, questioning, end quote, US dominance, but the final verdict will depend on tangible economic data in the months ahead. And speaking of the trade war, France is urging the European Union to consider deploying its most powerful retaliatory trade mechanism, the anti-coercion instrument, if US President Donald Trump follows through with new tariffs aimed at forcing the bloc into policy concessions. This marks the first time such a measure is being considered against the United States, reflecting escalating trade tensions between Washington and Brussels. The anti-coercion instrument, introduced to counter economic pressure from external actors, could enable the EU to impose a broad range of countermeasures, including trade restrictions, intellectual property limitations, and restrictions on foreign investment. While France is among a small group of EU nations advocating for its consideration, the measure is not the bloc's immediate course of action. Trump's administration is set to impose sweeping tariffs on global trade partners as early as April the 2nd, citing non-tariff barriers such as domestic regulations and the EU's value-added tax, VAT, which he argues put American companies at a disadvantage. The EU maintains that VAT is a non-discriminatory tax applied equally to domestic and imported goods. The US has escalated a global trade war by imposing a 25% tariff on steel and aluminium imports. In response, the EU has announced countermeasures targeting up to 26 billion euros, $28.1 billion US dollars, worth of American goods, a retaliation that could significantly surpass the scale of the metals-related duties. As of reporting on yesterday, the European Commission, which oversees trade policy for the EU, EU is not considering activating the anti-coercion instrument. Sources speaking to UK-based Reuters suggest that discussions remain preliminary and dependent on the specifics of the US tariffs expected in early April. The EU's reaction to Trump's metals tariffs is now expected to be delayed until mid-April, providing more time for diplomatic engagement. However, previous attempts by European Commission President Ursula von der Leyen and her staff to directly engage with Trump have so far been unsuccessful, with the US president repeatedly accusing the EU of exploiting American trade interests. The final decision on whether to deploy the tool lies with EU member states, who would first attempt diplomatic consultations before implementing retaliatory measures. Meanwhile, while we're still in Europe, Germany's outgoing parliament has approved a historic €1 trillion, $1.08 trillion spending package, clearing the way for Conservative leader Friedrich Merz to move forward with coalition negotiations. The constitutional reform, which passed with more than two-thirds support in Germany's legislative body, enables unrestricted defense spending and a special €500 billion infrastructure modernization fund. The package represents a significant policy shift aimed at reinvigorating Germany's stagnating economy and strengthening its military. The approval follows a race against time to pass the reforms before the current parliament's term ends. Merz, whose Christian Democratic Union, CDU, secured victory in last month's elections, took the unusual step of recalling the old parliament for emergency sessions to secure a supermajority. Marking a pivotal moment for Germany, the reform allows federal states to assume new debt while addressing urgent defense funding needs, estimated at over €400 billion in the coming years. To ensure the support of potential coalition partner, the Social Democratic Party, SDP, Merz agreed to the infrastructure fund too, while the Greens pushed for investments in green energy initiatives. Despite international approval, the spending package has raised concerns among fiscal conservatives, given Merz's previous opposition to loosening Germany's constitutional debt brake. It is worth noting for international listeners that Germany has long been very sensitive to fiscal discipline due to their experience after World War I with hyperinflation and the catastrophic effect that had on its economy. This explains why there is such a deep political culture of fiscal discipline in the country even today. If you want to be on top of the most up-to-date and significant economic and financial updates from around the world during this time of great global change and uncertainty, consider subscribing to Market Update, the bell notification icon, and you will be. If you're getting some value from today's episode, don't forget to hit the like button. Okay, now let's move to Asia. Global investors are retreating from Southeast Asian markets, redirecting capital towards China as concerns mount over the economic outlook of the region's largest economies. Indonesia and Thailand, the two biggest economies in the bloc, have faced significant foreign equity outflows this year, with their stock markets among the worst performing globally. Indonesia's benchmark Jakarta Composite Index recently hit a 4-year low before staging a partial recovery, while the currency remains near a 5-year low. The MSCI Indonesia Index has fallen about 16% in US dollar terms since the start of the year, while the MSCI Thailand Index is down over 12%. This exodus is fueled by global trade tensions and a shift by fund managers toward Chinese equities. Foreign investors have pulled $1.3 billion from Indonesian markets and $500 million from Thai equities this year, while channeling $13 billion into Chinese stocks, according to the Institute of International Finance. The appeal of Chinese markets, which we have discussed on my other channel, China Update, has been driven by a technology boom, particularly in artificial intelligence, with Hong Kong's Hang Seng Index surging over 20% year to date. Concerns about Indonesia's economic stability under President Subianto's expansionary fiscal policies have further unnerved investors. The country's 6% decline against the dollar, coupled with rising debt and a costly $28 billion school meals program, has exacerbated fears of fiscal mismanagement. The newly established sovereign wealth fund, Danantara, has also raised red flags over political interference. Meanwhile, Thailand faces its own challenges, with high household debt, 90% of GDP, suppressing consumer spending, and trade reliance on the US making it vulnerable to Trump's tariffs. Analysts warn that without urgent reforms, Thailand risks stagnation in a low-growth cycle. With economic and political uncertainty looming, investor sentiment towards Southeast Asia is expected to remain fragile. And finally for today, Google Wallet's entry into Pakistan this month marks a significant step toward a cashless economy in the South Asian country, offering users the ability to store bank cards, tickets, and other documents on smart Android devices. The service allows for contactless payments, transit access, and more, aligning Pakistan with global digital payment trends. The potential for e-wallet adoption is significant, with 60% of Pakistan's 240 million population having access to mobile data. According to the State Bank of Pakistan, digital payments totaled $130 billion in Q3 of 2024, representing 27% of all transactions. Despite this momentum, experts caution that Pakistan's weak data protection laws and fragmented regulatory framework could impede adoption. Moreover, Pakistan's sizable informal economy, estimated to be as large as the formal sector, poses additional hurdles. Most small retailers operate outside the banking system, avoiding taxes and relying on cash transactions. Experts argue that requiring transactions above a certain threshold to be conducted digitally could help formalize the economy, though this would necessitate stricter enforcement by tax authorities. One potential solution is linking Google Wallet to RAAST, Pakistan's instant payment system, which is already tied to mobile numbers. Danish Lakhani, CEO of fintech firm Naya Pay, speaking to local media, observed, quote, "If RAAST is integrated with Google Wallet, it could revolutionize Pakistan's digital payment landscape," end quote. So the rollout of digital payments in Pakistan is not just about convenience for consumers. It could be a game changer for the state, formalizing the economy in a nation that has seen years of economic turbulence. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. Have a good Monday, have a productive week, and I will see you all tomorrow.